Hello and welcome to the Full FX Unfiltered. My name is Colin Lambert. I'm publisher of the Full FX, and edition is in association with Baton Systems. And I'm delighted to be joined by Alex Knight, who is head of EMEA at Baton Systems. Alex, I hope I got that right. Nice to see you again.
Have. Yeah. Nice to see you as well.
Alex, what I wanted to talk to you about today actually was something of which FX is probably quite a big part, but only a part. And it's a subject that's getting more attention. It's payment risk and the payment function more generally. Now, I know this is something that you look at quite a lot, but maybe we haven't spoken about it enough. So what I wanted to is get your thoughts initially on, what are the risks that the regulators are so worried about in the payment space?
Sure. No, that's it's interesting, Colin. I mean, to be honest, this is a subject that we've not looked at a huge amount recently. I mean, you'll understand, working for Baton, I'm talking to people in sort of large banks of different functions all of the time. And sometimes we focus a lot on issues that we're familiar with. And I guess I'm really familiar with things like settlement risk and so on and so forth. And payments risk is almost a new sort of term for me in some ways. And I think in the industry as a whole, it's something that some people are really only just sort of starting to understand. Where this comes from is that regulators clearly have identified payments risk as a point of pressure for the banking industry as a whole. There have been some pretty well publicized issues in the last few years of payments going wrong. I think there's a sort of dirty little secret. There's a bit of an issue with banks that lots and lots of payments are misdirected, and the fact is that banks don't have as much control over the payments process as I think perhaps the regulators would like to do. They don't have, in many cases, an overarching risk function or policy that surrounds payments itself. They have individual systems and business lines that are driving payments. Each of those individual systems and business lines may have some sort of protective processes and risk mitigants, but as a sort of general function, they don't tend to have that, across the whole sort of horizontal, if you will. And where the regulators seem to be coming down on is that payments create risk, or incorrect payments create risk, not just of sort of the actual loss, which of course is material, but also in the terms of the challenges it can create for the payer, the bank, I guess in this context, that may find itself with insufficient liquidity to meet its real obligations if it's making payments in error. All right. And so where we've had conversations with people that have been really interesting. Actually, there's a module already contained within our core payment solution that sort of does this, and it's interesting conversations about just identifying the use of this module is allowing firms to be able to create, edit, modify, audit rules in a no-code environment that allow them to put in place configurable manual holds on payments of different characteristics. So I'll give you an example. Busy day and everybody's concerned about ruble. All right. Yeah. So what the bank may want to do is to say any ruble payment to any counterparty, of greater than X size, I want to have a desk head and a supervisor approve that payment. All right. So number one, they want to create that rule, and they want to create it quickly and in a compliant manner. Yeah. And number two, they want to be able to audit the actual use of that rule. So then by passing the payments through, for example, the Baton ledger, through our sort of manual payments configurable process, anything that doesn't trigger a rule will just go to STP all the way through, and the settlement will be initiated. Anything that does trigger the rule will require that a manual process as defined is carried out, and the payment has to be manually released. Yeah, you'd think it's simple. I guess that the interesting thing is that for a lot of firms that we talk to, were they to want to put a rule like that in place, it would require detailed conversations with their technology providers, and then a 3-month turnaround, and then a rule that's hard-coded and can't be modified easily, and so on and so forth. So configurable by time, by size, by counterparty parent, by currency, by product, all of these things, just allowing people to really take control over where they need to intervene to ensure that a payment that is being made appropriately.
Yeah. I mean, it's interesting, isn't it? It always comes back to, or it always seems to me to come back to that liquidity risk.
Yeah, absolutely.
Which is driving so much. So you're talking. Yes, it sounds simple in terms of the actual problem, but you're talking a lot of detail there, aren't you? So it probably is a lot more complex than it is, which inevitably drives us towards data and analytics.
Yeah.
Is this yet another job for the superhero that is data and analytics?
Look, everybody talks about data analytics in so many different contexts, don't they? And certainly at your conferences, Colin, there's a lot of conversation about data analytics for the purposes of execution and risk management and risk transfer and best execution and so on and so forth. And again, as sort of is normally the case, the sort of post-trade piece gets a little bit left behind. But again, when we think about liquidity and we think about FX businesses, but this is the full FX, think about FX businesses, and certainly in my time, working within an FX business, and I'm sure many people will be familiar with this. The end of the year, the FX business gets an allocation for its use of funding. And frankly, nobody can really understand how that allocation is derived, which is annoying. And everybody contests it in their own little sort of logic way, but without really understanding how to contest it. But also what's annoying is that people don't really understand what behavior they can take to reduce that allocation. Because they don't understand sort of how it's derived in the first place. And so what we're seeing more and more banks do is have people that are really directly involved in understanding the allocation and understanding the driver of the funding requirements, across all businesses. And I guess we're thinking here about FX. So, let's think about it from the context of the FX business. Now, that might be an XVA desk person, or it might be somebody in business resource management or some similar function. What we understand, what we see is the only way to do that when you're thinking about intraday liquidity, because that's what we're really talking about from a funding perspective, is to understand what the real drivers of your funding requirements are. And so to do that, what you need to then do is to understand on a time-stamped basis all of the inflows and outflows by counterparty, by currency, by business line, and so on and so forth, so that you can then run that analysis. And I guess, again, these things come in sort of curious ways. We've spent a lot of time working on the real-time reconciliation of statements versus ledgers. So we create, time-stamped data on payouts and pay-ins across whichever lines of business our customers choose to use us for. Once you've got that timestamp data, you can then run the analysis on it. The analysis will show you what your drivers of your funding use are. It'll also allow you to quantify your funding use, And that can then result in two outcomes: either a conversation with people internally to have with their counterparties. You have a particular client that perhaps always pays late in size, for example. You have a client that fails, that's another driver of liquidity as well. Or looking at the way you behave internally. How can we best sequence the way that we pay our obligations without just doing the obvious thing, which is to just do everything at the last minute, which would make you very unpopular with your counterparties, and it's just a race to zero, of course. Without doing that, but rather by intelligently sequencing those payouts that need to happen, as a matter of urgency, first thing, and those others where you might be able to sort of manage that process more effectively, and running simulations. But again, the heart of it is to have high quality timestamp data that you can access and use.
You triggered an old memory in me there, Alex, of my very, very young days in banking, being called upon as one of the young chaps in the room who had to sprint to the clearing bank. It was a long while ago. Sprint to the clearing bank with a check at like 3 o'clock to get it in before the 3:05 deadline. Really? And that happened on a daily basis. So we were very last minute when we didn't have data analytics.
I look back on my history, and I remember being in the office of the guy who ran global FX for the firm I worked at. And his COO came in and he pointed at my business line and he said, "You guys have got an allocation of $60 million. What do you say?"
Thanks. Or is it a thank you, or is it a
Exactly.
Yes, I totally get that. Something I did want to raise with you, Alex, actually, you spoke on one of our panels at the Full FX London, and we had a rip-roaring 25 minutes, I have to say, looking at that sort of T+1 general issue. But someone raised a question of multilateral netting. And your answer quite intrigued me, because you said there's pros and cons to it. And I guess in my simplified view of the world, I've always looked at it and said, well, yeah, it's a great thing. Can you explain a little bit further as much for me as anybody else, I'm sure the audience would love to hear it, what the cons are as much as those pros.
Yeah, sure. It's a really interesting thing. Is I think I get asked a lot about multilateral netting, all right, as we were in that panel. And the benefit of multilateral netting, of course, is that it reduces every party's obligation to their net obligation across all of their counterparties and across all currency pairs. The con is that you have the entire ecosystem needing to find their funding at the same time or around the same time, often in periods of low liquidity. So, I often use this expression, everybody has to march to the beat of the same drum. All right. And you then have your sort of funding locked up for, a few hours. So you have this impact on the market, which is to pull funds out of available funds out of the market in a fairly concentrated manner. Now there are mitigants to that, which we can argue whether they're effective or not, but that is the sort of the driver there. And actually, it was just interesting. Just shortly after I was on that panel at your conference, I sort of saw the first stage of some analysis we've completed for a customer. And what that customer had asked us to look at in a simulated manner was the benefit of splitting settlements. All right. And so splits, I think, are a really interesting thing to think about. And just, everybody will know how to, a split settlement is where you divide your overall obligation into smaller sizes.
Yeah.
It's an obvious thing to do. I think from an ops perspective, it's a challenging thing to do. You'll see that most ops businesses don't like to split. Sorry, go on.
Is it also over time, split over time as well as by amounts?
Yeah.
It
is. Exactly. Okay. So what I'm talking about is splitting over time. And I'll come on to how we did the analysis. But just in terms of splitting, one of the challenges that people have about splitting is that it's operationally intensive. You're creating more payments. You're creating, the need to coordinate, to collaborate with your counterparties. And in fact, if you look at something like Turkish, where everybody knows it's impossible to settle in size, the way that people get around this in large part is not by splitting settlements, because that's operationally complicated, but rather by transacting in small size, which is another great example of the tail wagging the dog. Operational constraints force the front office to trade in a manner that they wouldn't otherwise trade in. It's bizarre. All right, so that they can then settle each small piece in its own right. So when we looked at splitting settlements, what we looked at was the process through our core FX solution, which has this process for collaborative workflows. And so what we have is the opportunity for a pair of counterparties, in fact, even a group of counterparties, to agree that they are going to split their settlements into equal portions over a number of predetermined settlement cycles. So, you could say 10 settlement cycles is what we're going to run, for the currencies or currency pairs in question. And we're going to run them at 10 o'clock and then 10:15 and then 10:30 and then 10:45 and so on and so forth. Now, because the Baton system actually allows settlement to occur really quickly with PVP, in that sort of 5-minute window with the actual ownership exchange being instantaneous. Because that process is so quick, it allows you then to stagger your payments process, and that allows for the recycling of funds, and it really reduces the amount of funding that's being drawn down from the market as a whole, but also the amount of funding that individual parties need to find at any one point during the day. And that's looking at the numerical results is absolutely fascinating. And I really hope we're going to be able to share them more broadly with the market over the course of the next few weeks.
Yeah. And it sounds interesting because it's interesting. Another thing from our panel was the T+1, and it was that trade-off between settlement risk or funding risk, wasn't it? Yeah. And it does seem to me that, we are as an industry facing more potential, I should stress the word potential, funding logjams.
Yeah, absolutely. Yeah, I think that's exactly right. And people try and find their way around it. Collaborative workflows, honestly, and speed of settlement, I think they really get to. So how do we move forward from here? I think this is really interesting. Parties getting their heads together, agreeing sensible settlement schedules, with one another, perhaps en masse, perhaps groups of parties, and that way then allows for a real reduction of the, as I said, of the funding requirement at any point of time. And importantly, these collaborative workflows that we already operate, these collaborative workflows, they just don't touch the sides from an operational perspective. So you're not adding a burden to the ops process. It's really straight through.
And I guess it can be systematized to a degree.
Totally.
You can turn around and say, actually, these are the times at which we're going to do these payment runs.
Yeah, exactly. Exactly. So
Definitely.
I think it's really interesting. It's a really interesting, it's a different way to look at how you can sort of manage your funding process without obsessing always about, is it multilateral netting or not?
Yeah. And it's interesting. I mean, and yet again, in the conversations that you have and I have had over the years, there's an obvious link back to the front office and making the front office more efficient and actually freeing up the front office to actually do their job a lot better.
Totally. Absolutely. Yeah.
It's amazing how it all loops around. As always, Alex, it's really fascinating to talk to you. Thanks so much for your time today, because I think this is something we will be hearing more about, and hopefully through the full effects we can help share some of those findings from your study.
Absolutely. Well, we look forward to sharing it. Absolutely. And Colin, thank you so much for your time today. Great to talk.
Always nice to talk to you, Alex. And it's always great to have you as our audience. So thank you very much for watching, and we'll be back again very soon. Thanks a lot.